Guru University Fasseminar, a micro-learning webinar series, business, an introduction, content, introduction by Chi Art, Guru University founder. 1. What is business? 2. The 4 M's of business. 3. Money. 4. Marketing. 5. Management. 6. Macroeconomics and microeconomics. Introduction by Chi Art, Guru University founder. Welcome everyone to Guru University, and a special hello to you who's currently starting this Fasseminar in Business and Introduction course. In this course, you will learn straightforwardly, quicker, clearer, easier, simpler, and much faster and more practical, and extra swifter about the field of business. Here at Guru University, we aim to provide everyone around the world free education and a very affordable way of attaining academic and vocational credentials to further improve their career. In this business and introduction course, you will learn about the required knowledge and skills for you to grasp that fundamental understanding about all the things you need to know in the world of business. So this is where you start. Let's go. 1.0 What is business? The most straightforward definition of business is an activity of selling products or services to buyers with the goal of achieving profits. There are many exaggerated definitions and write-ups on the internet, books and journals about what business means. Well, let us make it easier and clearer for you to understand and learn it. Here in Guru University, we call it the 4 M's of business, which consists of 1. Money, 2. Marketing, 3. Management, 4. Macroeconomics and microeconomics. 2.0 The 4 M's of business. In this concept of 4 M's, we at GU have encapsulated all of the concepts and factors in business into one comprehensive grouping designed to provide an integrated understanding about the knowledge of business. So the first M is money. The first 3 subjects of money are what we at GU term them as the transactionals. The transactionals are the activities, actions, and circumstances which involve the most important and literally practical parts of business. The transactionals are 1. Costs, 2. Sales, 3. Profits, 1. Cost. Definition: the values of the materials and actions a businessman needs to pay before transforming them into the products and services of which they wish to sell to buyers. The materials and actions are bought from suppliers who can be another businessman, tile seller, wholesaler, or factory, the producer. Example: a businessman pays $100 for 10 pieces of t-shirts to be sold later. Therefore, the total cost is $100 and the cost per piece is $10. 2. Sales. Definition: the final selling price of products, services a businessman imposes to be sold to the buyers. The simplest formula to arrive at the selling price is to add markup values over the costs which have been paid by the businessman to get the product services to the market. Example: after paying a cost of 10 pieces of the t-shirts, the businessman decides to sell to the buyer 15. The difference of the sell or sale and the costs is $5, meaning the businessman imposes a markup value of $5 per t-shirt. After selling all of the 10 pieces of t-shirts, the businessman makes total sales of $150. 3. Profit. Definition: means the final gains after total sales being deducted of total costs. The achievement of getting more values of total sales over the total costs is called profit. However, the failure of getting more values over the total costs is called loss. Example: a businessman makes total profits of $50 from the sales of all of the 10 t-shirts, as he sells a t-shirt at $15 over his cost of $10, which translates into a profit of $5 piece. However, if he sells the t-shirt at 9 piece, that means he imposes the value of sale $1 lesser than his cost of $10 piece, which translates a loss of $1 per t-shirt, and total losses of $10 for all of the 10 t-shirts. Okay, before we move on to the other money subjects, we wish to add one more transactional subfactor of the costs, the additional costs. The additional costs are the costs of the other matters the businessman has to pay in order to ensure the product service is ready to be presented and sold to the buyer. Apart from buying the t-shirts themselves, the businessman may have to pay for the transportation, storage, packaging and advertising for the t-shirts in order to entice the potential buyers to buy them. So if these additional costs total to, for an example, 50, the businessman needs to add this amount to his previously total costs of 100, eventually totaling up to 150. The new total costs of $150 must be divided by 10 pieces, which will translate into a cost per shirt of $15. So now, if the businessman imposes a sale price of $16 or above for a piece, he will make a profit. But if he imposes it $14 or lower, he will make a loss. All right, now let's look at the rest of the money matters. B capital, the resources and assets a company utilizes to operate, generate revenues and fund its growth. Generally, capital is anything that can be used to produce goods and services or to generate profits. Types of capital forms: 1. Financial resources, cash, investments and loan. 2. Physical assets, buildings, equipment and inventory. C. Budget and forecasting. Budget, plan outlining the expected income and expenses for a specific period, often a year, to control spending and achieve financial goals. Forecast, projection of future financial outcomes based on historical data, used to predict what a company might achieve or what they need to do to meet their budget. Detaxation, when a businessman has achieved his profit from the entire operations of the business, that specific amount of profit will be taken away by government. This process is called taxation. Whilst every government of every country around the world imposes many forms of taxations on their citizens' business, tax is a special taxation imposed on all of the companies that produce profits in a span of a year. The government will impose a certain percentage of the profit of the business, and this rate or percentage differs in different countries. 3.0 Marketing. To be practically honest, many publications and people have defined the term marketing wrongly. Marketing is not just the act of promoting and selling the products and services. Marketing is the discipline of doing all parts of the business, and many people have underrated this. To understand this concept wholly and simply, we must look at the concept of the 4 Ps of marketing. The 4 Ps of marketing, traditionally known as marketing strategy, are all the main and intertwining elements in starting and operating the business, from the decision of what to sell all the way through and to final stages of selling it to the customers. Let's look at the 4 Ps now. Mainly, the 4 factors that start with the letter T. 1. Product, deciding the right product. Service to sell and whom to sell it to. 2. Price, deciding the suitable selling price for the product service and also the costs. 3. Place, determining the locations to market the product service and also storage and warehousing. But promotion, determining the methods and efforts to deliver the information and communication of the product service to the targeted customers. So as you can see, if there is no marketing, there is no business. 4.0 Management. Business management encompasses all of the processes of planning, organizing, directing and controlling an organization's resources and activities to achieve goals and objectives. It involves overseeing various aspects of the business, including finance, marketing, human resources, and operations, in order to ensure efficient and effective performance. Here in GU, every aspect of the business is divided into different disciplines of managements, named as main business functions, MBF. Here are some of the MBFs you will find in every serious and established business operations. 1. Marketing management. The management all the main elements of operating a business, including marketing strategy, the 4 Ps of marketing, market segmentation, market research is marketing, channels and media, and branding. 2. Financial and accounting management. The management of planning, budgeting, controlling financial resources, recording, analyzing, and reporting financial information to achieve organizational goals. 3. Human resource management is strategic approach to managing people within an organization to help them achieve its goals and gain a competitive advantage, encompassing activities such as recruitment, hiring, training, compensation, and performance management. 4. Operations management. The management of business practices, why processes to improve efficiency and maximize profitability by focusing on transforming inputs, such as materials, labor, and energy, into outputs, goods and services for consumers. Very critical in manufacturing, production, and service provision. 5.0 Macroeconomics and Microeconomics. Microeconomics is the study of individuals and business decisions. Macroeconomics looks at the decisions of countries and governments. To easily comprehend this, macro means large and external, whilst micro means small and internal. To have overviews about both, we must look at the factors surrounding them. Macroeconomic factors, the broad economic conditions and indicators that affect the overall performance of an economy. 1. Public policy. Government policies, including regulations and taxation laws, can have profound impacts on the economy. Also, monetary and fiscal policies, which tend to stimulate and control the flows of money in the economy, or the lacking thereof, will critically affect businesses too. The interest rates are also a factor that can influence the overall economic activity. 2. Inflation, referring to sustained increase in the general price level of goods and services the economy, which may erode purchasing power and can lead to a decrease in the value of savings and investments. 3. Unemployment, represents the number of people seeking employment but are unable to find jobs. High unemployment rates can lead to a decline in consumer spending and economic growth. 4. Business cycles, referring to the cyclical fluctuations in economic activity, including periods of expansion, recession and recovery, which will influence and impact businesses. B. Microeconomics factors, the individual choices and decisions made by consumers and businesses that influence the economy, determining how resources are allocated, how goods and services are produced, and how prices are set. 1. Supply and demand, where the price of a product or service is determined by the balance between what producers are willing to supply and what consumers are willing to buy. 2. Consumer behavior, factors like income, price, tastes, and advertising all influence consumer choices. 3. Production costs, the costs of labor, raw materials, and capital are important determinants of a business production and pricing decisions. 4. Market structure, the level of competition in an industry affects how companies behave and how prices are set. Case study, how microeconomics and macroeconomics affect and impact a t-shirt selling business. Microeconomics, if the demands for the t-shirts that the businessman is selling are high, the businessman can produce the products more, and this will result in lower production costs. So this concept is called the economies of scale, where the more quantity in the production will result in the lower costs of it. Competitions from other t-shirt producers will create more variety for the consumers to choose from, which will deem the businessman's products less appealing. More competitions in pricing will drive down the selling prices, which will affect the business profitability. The increasing costs of production, such as labor, materials, and advertising, will impact the profitability of the business. Macroeconomics, if the government increases the interest rates, the costs of everything will be higher, such as loans and other financial instruments, which will lead all the players, such as suppliers, vendors, producers, to increase their prices, will affect the economy, thus will slow down people's purchasing speed and power. Global problems such as the COVID-19 pandemic will affect negatively on the international trade, which will affect the economy in many ways, such as lower consumption, shortage of raw materials, and slower exporting activities. The general economic cycle, which sometimes arrives at a recession stage, will reduce the activities of economy, massively impacting all business players, big or small. Congrats! You have completed this Fasseminar course. Should you wish to be awarded with a certificate for this course, please contact us through DM or WhatsApp us at 014 756 9645. You will be required to undertake a simple and straightforward assessment based on your learning and comprehension of the course. Want to get more coaching, tutoring, and mentoring regarding this course? Sure, you can get direct online coaching, tutoring, and mentoring from our practically and industrially experienced gurus. Please contact us through DM or WhatsApp us at 014 756 9645